We are currently witnessing a silent but aggressive divergence in institutional order books that most retail investors are completely ignoring. The data streaming in from over-the-counter desks and custodial wallets suggests that the smart money is already preparing for a massive structural shift that will catch the majority of the market off guard. If you are sitting on your hands believing that the spot exchange-traded funds are a permanent guarantee of infinite buy pressure, you are positioning yourself to be the exit liquidity for the next phase of the market cycle. The reality is that the institutions who bought your Bitcoin in 2024 are not planning to hold it forever in a passive vehicle that charges them management fees. Over the next few minutes, I am going to present undeniable evidence suggesting that by 2026, we will see a massive capital rotation out of passive funds and into on-chain real-world assets. I will show you exactly why the exchange-traded fund inflows are destined to plateau and how a new asset class is poised to absorb trillions of dollars in liquidity. This is not speculation based on hope, but rather an analysis of the plumbing of the financial system. Let us get into the weeds of what is actually happening behind the scenes at the world's largest asset managers. To understand the future of 2026, we must first strip away the marketing hype surrounding the current exchange-traded fund landscape. For the past 2 years, the narrative has been entirely focused on the idea that Wall Street is buying Bitcoin to hold it as a long-term store of value. While that was true for the initial accumulation phase, we are now seeing the 30-day moving average for exchange inflows hitting a 3-year low across several major desks. The initial pent-up demand for passive Bitcoin exposure has been largely satisfied, and we are approaching a saturation point in the traditional brokerage accounts. What most people fail to realize is that an exchange-traded fund is a very inefficient way for a sophisticated institution to utilize capital. When a bank or a hedge fund holds Bitcoin in an exchange-traded fund, that capital is effectively dead weight because it sits in a vault and generates zero yield. Institutional capital is not loyal to an ideology. It is loyal only to yield and efficiency. This is where the narrative for 2026 begins to shift dramatically toward real-world assets. The reason this matters is that tokenized assets allow institutions to use their capital twice. They can hold a tokenized treasury bill that pays them 5% interest and simultaneously use that token as collateral to trade or lend within the crypto ecosystem. As we look toward the horizon of 2026, the data suggests we will see a decoupling between the price of Bitcoin and the net inflows of these funds. We are likely to see a trend where institutions redeem their shares in exchange-traded funds to move that liquidity on-chain into tokenized products. This would look like a bearish signal to the uneducated investor watching the daily flow charts, but it would actually be a bullish signal for the broader blockchain economy. It represents the migration of capital from a passive viewing gallery into the active playing field of decentralized finance. If this level of deep dive analysis is helping you see the market with more clarity than the average participant, feel free to join our inner circle by subscribing to the channel. We focus on the data that the mainstream media tends to overlook until it is too late. Now, let us look at the specific sectors of real-world assets that are attracting the most attention from these whales. The first and most obvious sector is the tokenization of United States Treasury bills. We have already seen giants like BlackRock dipping their toes into this water. But by 2026, this will likely be a flood. The logic is undeniable because stablecoins currently sit in wallets earning nothing for the user, while the issuers collect all the interest. Institutions will not accept that arrangement for long. They will demand a form of digital cash that passes the yield from government bonds directly back to the holder. This transition will likely drain liquidity from the traditional banking sector and move it onto public ledgers like Ethereum or Solana. The second sector that is flashing green on our proprietary indicators is the tokenization of commercial real estate. Historically, real estate is an illiquid asset class that is difficult to trade and difficult to use as collateral in real time. By moving these titles on-chain, institutions can create a 24-hour global market for property that settles in seconds rather than weeks. The reality is that the technology to do this has existed for years, but the regulatory framework and institutional appetite were missing. However, as we approach 2026, the regulatory clarity in jurisdictions like Europe and parts of Asia is paving the way for this to become standard practice. We are looking at a future where the total addressable market for real-world assets could eclipse the total market capitalization of all cryptocurrencies combined today. This brings us to a critical warning about the transition period. When this rotation begins in earnest, we may see a temporary suppression in the price of Bitcoin as capital rebalances. The algorithms that trade based on exchange-traded fund flows will likely misinterpret these redemptions as a loss of confidence in the asset class. Smart investors need to be prepared to distinguish between a market exit and a market rotation. If you see billions of dollars leaving the exchange-traded funds, but simultaneously see the market capitalization of tokenized assets exploding, do not panic. That is simply the money moving from a dial-up internet connection to a fiber optic connection. It is an upgrade in the utility of the capital, not a departure from the ecosystem. Here's why this matters for your personal portfolio construction over the next 2 years. You cannot simply rely on the rising tide of Bitcoin to lift all boats if the water is flowing into a different harbor. You need to identify the infrastructure protocols that are building the bridges for these real-world assets to come on chain. The winners of the 2026 cycle will not just be the store of value assets, but the networks that facilitate the transfer and settlement of trillions of dollars in tokenized securities. We are talking about the oracles that verify the off-chain data and the layer 1 blockchains that offer the security and speed required by Wall Street. This is a much more complex game than simply buying and holding, which is why staying informed is your only hedge against obsolescence. If you want to ensure you are positioning yourself correctly for this rotation, consider turning on your notifications so you never miss a strategic update. Let us continue by examining the risks associated with this transition to real-world assets. The primary risk is regulatory fragmentation. While the United States has been slow to provide clarity, other nations are racing ahead to define the rules for tokenized securities. This could lead to a scenario where liquidity is fractured across different jurisdictions, making it harder for a unified global market to form. However, the history of financial markets tells us that capital always finds the path of least resistance. We are already seeing major banks in Singapore and Switzerland piloting projects that connect their legacy systems with public blockchains. By 2026, these pilots will likely be fully operational production environments. Another risk to consider is the technical risk of smart contract failure. When you are dealing with trillions of dollars of real estate and government bonds, the code cannot have bugs. This will drive a massive premium for protocols that have a proven track record of security and uptime. The institutions entering this space will not be gambling on unproven experimental chains. They will flock to the battle-tested networks. This flight to quality will likely cause a consolidation in the market, where 90% of the altcoins vanish and the top 1% capture all the value. So, what does the playbook look like for the astute investor preparing for 2026? First, you must monitor the quarterly reports of the major exchange-traded funds for signs of slowing inflows or increasing redemptions. Second, you need to track the total value locked in real-world asset protocol. If you see a divergence where Bitcoin is flat but tokenized treasury volumes are vertical, that is your signal that the rotation is underway. Third, look for partnerships between traditional financial custodians and blockchain infrastructure providers. These announcements are often boring and filled with corporate jargon, but they are the breadcrumbs that lead to the next bull market. The era of speculative mania is slowly being replaced by the era of utility and integration. The institutions are done playing with digital collectibles. They are now focused on digitizing the global economy. Those who understand this shift will be positioned to capture the value of the next decade, while those who ignore it will be left wondering why the old narratives stopped working. In conclusion, the warning I started with remains valid. Do not let the current lull in the market fool you into complacency. The lack of volatility right now is simply the calm before the structural migration of capital. The exchange-traded funds were the Trojan horse that brought Wall Street into crypto. But real-world assets are the army that will actually occupy the territory. Your strategy must evolve from simple accumulation to understanding the mechanics of yield and asset tokenization. The market of 2026 will look nothing like the market of today, and the preparation you do now will determine your standing in that new reality. Please remember that everything discussed in this video is for educational and informational purposes only. I am a market strategist analyzing data, not a financial advisor giving you personal instructions. All financial markets carry significant risk, and you should always conduct your own due diligence and consult with a certified professional before making any investment decisions. The future belongs to those who see the rotation before the crowd turns around.